and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, May 16th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we've got futures that are pointing just a little bit lower. Dow futures down about 101 points, S&P 500 futures down about 7, NASDAQ futures also down about 7. So we're getting a little bit better action this morning on a relative basis in the NASDAQ 100. Crude oil prices down fractionally, down about 8 cents, still hovering around the $71 a barrel level. And then we've got the 10-year Treasury yield down 2 basis points, just a tad below 3.49%. That continues to trade in a fairly wide trading range. We got a couple companies out with some news, earnings news. Home Depot, they're actually trading down a little bit after posting revenues that fell short. Talk about that just a little bit. Let's go ahead and walk through today's agenda. So I'm going to start off with the daily market recap. Then we'll do talking technically. Chart of the day. This is an interesting one. Stock was up yesterday, but the scooter went down. We'll talk about that for just a brief minute or so. Then international stocks, I want to show you a little bit about what's going on there and why you need to at least pay somewhat attention to the dollar if you are trading in the ETFs that track international indices. Look at growth versus value, earnings, excuse me, earnings spotlight, and then the 3 you must see. So let's go ahead and start off with that daily market recap. So on Monday, May 15th, we had the Dow Jones Industrial Average rise 48 points, back up to 33,348. S&P 500 was up 12 to 4136, still looking for that 4179 level. That's the key level there, about 1% away. NASDAQ up 80, 12,365, still 2-3% away from a key breakout there above the August 2022 high. Mid caps up 19 points, up about 0.75%. Small caps actually performed best yesterday, up about 12 points. That was a little more than 1%. So pretty good action across the board. Still no major breakouts. The NASDAQ continues just to drift a little bit higher, but otherwise we're still waiting for some big breakouts in the major indices. Looking at the sectors, we've got materials up about between 8 and 0.9%. Technology up a little more than 8%, 0.8%. Financials also up about 0.8%. And then energy up 0.5%. Those were the leaders on Monday. The laggards were the defensive groups. So utilities led those 3 groups down. Actually, I think all 4. I know earlier in the day, all 4 defensive groups were lower. They were the only 4 in negative territory. But the leader was utilities. That group dropped about 1.25% on Monday. Moving on to the 10-year Treasury yield. First of all, a lot of economic reports out today, so you want to check on these. April retail sales expected to climb 0.7%. March fell 1%. So this is a big reversal that we're expecting for April. April retail sales, if we strip out the autos, expected to rise 0.4%. Again, that's versus minus 0.8%. So another big jump in expected April retail sales if we strip out the autos. Then we've got April industrial production. March rose 0.4%. April, we're expected to backtrack, and it's supposed to be flat. April capacity utilization, 79.8, which matches the March 79.8. Then we got March business inventories, and it is definitely a lagging report, although we're talking about March, and here we are in mid-May, not too far away from June. But I like to follow the business inventories just to make sure that inventories aren't rising too much as business slows down a little bit. One thing we got to at least keep an eye on is the potential impact, or not impact, but potential occurrences maybe, or I don't even know what the right word is, but deflation. I still think the biggest risk to the market and what the Fed's done is that they've gone too far, raised rates too much, and as a result, business drops and we get into a spiral to the downside, to get rid of inventory, you have to keep lowering prices. I don't think that is going to be a problem. I'm just saying, of the things that a lot of the media talks about, I'm much more concerned about deflation than I am a possible short-term recession kind of a environment, because recession is going to bring your interest rates down. That's going to increase valuations. And we're seeing growth stocks crushing value stocks in 2023. So for those thinking that we're heading into some kind of a really deep recession, that is not at all what the stock market's telling us. I'm sorry. I look at I don't listen to the people talking. I look at what the charts are saying. And the charts, money's moving into growth. You can't deny it. Look at any growth versus value chart out there. I'm going to show you a couple that might shock you in just a little bit. But anyway, still, I'm watching the inventories, and so far, so good. Not really a problem there. May housing market index will be out later this morning. That's expected to come in at 45. April was also 45, so no change there. Anyway, all those reports will be out after this recording is done. But by the time you listen to this, after 9 a.m. Eastern, you should be able to check on most of those reports. Like I said, a couple of them will be released later in the morning. I know May housing market index comes out at 10, but some of the others will be out at 8:30. So make sure you check on those, and we'll see what kind of reaction we get. Let's move on. Well, 10-year Treasury yield. I mean, there's not a whole lot more to say about this. I've talked about this for quite a while. I mean, I think we're in an intermediate term downtrend. I think if we pull up a 5-year chart, 3-year chart, you'll see we're still in a what I would consider a longer term uptrend. And as long as that low down here in August around 255, as long as that holds, I believe the longer term uptrend remains in play. And I'm kind of mixed on whether or not I think we go below 255 down the road. I do think we could go back and test it. I wouldn't be surprised. That might be later this year, maybe into 2024, but I wouldn't be surprised to see yields drop back down, 10-year Treasury yield drop back down near that August low that we saw there. But in the meantime, short term, I think we're just in this trading range, 327, 365. Looks like it's narrowing. I don't know. Maybe we're getting a little bit of symmetrical triangle, connecting the highs coming down, connecting the lows going up. If so, we're squeezing, probably going to get some type of resolution here in the fairly near term. I would say probably over the next couple of weeks. But do we break out to the upside or do we fall back to the downside? Don't know. We're going to find out. Moving on, let's talk a little bit about the technicals here. So talking technically, S&P 500 continues to trade in this very narrow range. This is now 6 days in a row that we've had opens and closes below 4,100 and 4,150. And we've got short-term support down at 40.50, short to intermediate term resistance 41.79. And as I keep saying, the big one to the upside is 43.05. That's the August high. We're still sitting right in the middle of this range, not really doing much in the S&P 500. So waiting on a breakout or possible breakdown there. We'll wait and see. Nothing yet. NASDAQ 100, though. Hold on, let me get back to the daily chart. NASDAQ 100, you can see, is continuing its uptrend, and it is moving closer and closer to that August high, and that's what we want to see. We want to see ultimately a breakout above that mid-August high on the NDX. Not quite there yet, but what I do continue to see, and the reason I had this 5-day chart up here, is I want you just to look here the last 4 days. I mean, this has been the pattern that I've talked about mostly for the last year. But look at the afternoon. So morning we gapped up, then we sold off all day till we got close to 2 o'clock. Big rally back to the highs of the day in the afternoon. Next day, morning down, have a little rally, come back down, and then just before 2 o'clock, rally into the close. Slight gap up on Friday, selling off all the way until when? 2 o'clock. What happens from 2 to 4? Another big rally. Finishes back in the middle of this trading range. And then yesterday, start off a little bit strong, go into negative territory, and then rally until about 1, pull back, and guess what? Just around 2 o'clock, we rally again into the close. So the morning weakness, the amateur hour, is still somewhat in play. I mean, we're seeing it still almost every day. And yet, afternoons, what do? We rally. And what does that mean? That means when we get to the chart, this daily chart, and we're looking at the AD line. AD line's based on where you finished at the end of the day relative to where you finished or where you traded during the day. So when you get these strong finishes, it's adding to the accumulation distribution line, suggesting that there continues to be accumulation in the market. Volume trends are very strong. I mean, up days seem to be on heavier volume than down days. That was a little reversal from what we saw in 2022. But anyway, look at that AD line. Continue to strengthen. Go back to the S&P 500, the AD line right there. New highs. The S&P hasn't broken out, but the AD line keeps moving up. I think this is all meaningful information. I've been talking about it, like I said, for a year. The manipulation that's been taking place in the market, all the bad news being cast upon us while Wall Street continues to buy all the shares we want to sell. That's how it shows up. All right, let's move on to the chart of the day. So first thing I want to do is take you over to earnings beats. If you like the chart of the day, if you go down here, you'll see in the middle of our homepage at earningsbeats.com, you can sign up for our free Earnings Beats Digest newsletter. It's a 3 times a week newsletter, essentially giving you the chart of those days. We look to provide charts that kind of teach a little bit about what we do, how we look at the market. I'm not suggesting, if you're already a trader and you do well, probably maybe don't need to change a whole lot, maybe just tweak a few things. Hopefully we're providing some things that will help you in your process, whether it's you're looking at the overall market, whether it's picking individual stocks, whether it's just adding one indicator that maybe you didn't use before. Probably 3 years ago, before the pandemic hit, I never used the AD line. Never. I hadn't really looked at it. And as we went through the pandemic, I can't recall if a member suggested it to me or if I had actually just stumbled upon it. Because I was starting to see a lot of gap downs and recoveries, and I was trying to come up with something that would kind of depict what was really going on in the market. And the AD line was it. So I know I've had members write in and say they now use the AD line on their charts as their default. So do I. And for good reason, because we've all been manipulated for 3 years now. Pandemic didn't last. It was a healthcare crisis. Obviously, there were some financial effects, but it was a healthcare crisis. Long term, we were still fine. We had to adjust. There was certainly an adjustment period. Market went down for 30 days, actually 4 weeks, and that was it. We went right back up. And during the period while it was going down, we were getting gap downs followed by afternoon recoveries. Very similar to what we've been seeing for the last year. As everyone worries about inflation, interest rates, the Fed, recession, you name it, blah, blah, blah. It's all part of a game as far as I'm concerned. Pretty significant conflict of interest. We all need to be aware of it on Wall Street, the big Wall Street firms. They invest their own money on their own behalf. They invest for wealthy clients. Then they've got their analysts that go out and tell everybody what to buy and what to sell. So you got them doing their own thing, then them telling us what to do. And then, by the way, if it works and we all listen to their analyst and we buy and sell what they're saying, they've got market makers on the other side doing the opposite, making money after encouraging us to buy or sell, they're on the other side of the trades providing liquidity. Pretty good gig they got going, to be honest. Invest your money, tell everybody else what to do, and then do the opposite. What a great gig. So we try to expose some of that too in our Earnings Beats Digest. I mean, honestly, when I trade, I always say, get on the side of the market maker. They don't lose money. If you can figure out what a market maker is doing or have a general sense, you're a leg up. And by the way, later today, we're going to have a discussion pretty much about that. The Tuesday before options expiration, we have a monthly event for our members at Earnings Beats. And so guess what today is? It's the Tuesday before options expire. Last month, Riot blockchain, RIOT, was trading at 1360 or something like that. Max Pain was at 10 or 10 and change. We said the risk of being long Riot blockchain was off the charts. 4 days later, Monday after options expired, Riot blockchain was at $10. I don't make this stuff up. I just report on it. Anyhow, if you want to come to that event, it is a member-only event. Good news, though, 30-day free trial. You can come on in. We do have a 30-day free trial. We also have a big event coming up on Thursday, putting stocks into our 3 portfolios. Long-term, excellent track record with our portfolios. Short-term, it's been more challenging without a doubt with the rotation, with the cyclical bear market last year. We've been trying pretty much just to conserve capital during periods like that. But anyhow, if you want to know the stocks in our portfolios, 3 portfolios, that'll be on Thursday for our members. Great time to join. Also notice we've got this coming up in just a couple of days. That actually is now just 2 days until our spring special starts on Thursday. Anyway, check us out. Go over to earningsbeats.com. So let's take a look at BEKE. So if you go to the your dashboard, you'll see down below under scooter reports, you see how BEKE has dropped 13 scooter points in the last day. This is a daily change. So BEKE was 84.4 and it dropped to 71.2. And I'll occasionally look at these just to see which stocks are struggling. But one thing you may not know is that just because the scooter score goes down doesn't mean a stock has to go down. Let me show you in this chart of the day, BEKE. So this is KE Holdings. Look at the stock. It went up 4% yesterday, and the scooter dropped 13 points. And you're like, wait a minute, how does that happen? The scooter's, it's a relative strength thing. And clearly, gaining 4% yesterday, you would think you'd gain some relative strength. And instead, BEKE dropped 13 scooter points. Well, I would encourage you to go into the chart school and actually look at the formula. But part of what they look at is the rate of change over certain time periods. And so when you're looking back, you could go up 4% here, but if the cutoff back here, you go up 7%, you actually, your rate of change from this to this actually goes down. Your scooter score will go down. So it's not just what you're doing now, it's also what you were doing on the days that are dropping off out of the rate of change calculation. So again, if this was up 4%, but this day, let's say this was the last day, this gapped up, I don't know, say 7%. So you can see that your actual rate of change went down, even though we went up 4% yesterday. And that's how you can get a scooter that falls. It's not always about what's happening today. It's also what's happening at the other end of the spectrum. What days are dropping off the calculation, not just what days are adding on to the calculation. Anyway, check that out over at Chart School if you have any questions. But I always like to bring it up because it's odd once in a while. It doesn't happen very often. But occasionally when you get stocks that have gapped up and they happen to filter into the calculation, you can see some oddities like that. All right, let's move on to international stocks. And what I really wanted to just point out here was here's the DAX versus the S&P 500. And I've been saying that, hey, some of these foreign indices are outperforming the S&P 500. German DAX in September has been going up. And when you look down below here, you look at the EWG versus the SPDR. EWG tracks the DAX, and the SPDR tracks the S&P 500. And you look at this, and you say, wait a minute. The DAX versus the S&P over the last 2 months has gone down. Why is the EWG relative to the SPDR going up? How can we be setting a higher ratio on the ETF when the indices are going lower? The answer, the dollar. When the dollar goes down, that actually increases the performance of the EWG. There's a currency translation component. So when you're getting into an index, a foreign index, but you're using an ETF, you have to also consider the currency impact. So if the dollar is going down, that is going to help your EWG investment on a relative basis. In other words, you're going to do even better than what the DAX is doing relative to the S&P. You're going to have an add-on. A weak dollar helps you. But when the dollar is strengthening, the EWG gets hit even harder. I mean, look right here. See, this is the DAX versus the S&P starting to move up. Over here, we got an equal low. That goes up. This doesn't. What the heck? Strong dollar. Look at that dollar soaring right there. That's what takes the EWG down. So if you want to get involved in international ETFs, that's fine. That's great. But if you don't understand performance sometimes, and you're looking at the index saying, wait, the index is going one way, and my ETF that tracks it's going the other, what the heck's going on? Check out the dollar. Just a little tip there. All right, growth versus value. I wanted to just show you the IWM, which clearly has been going down for the last 3 months. I don't think anyone's going to argue. Still above the lows that were set in June and October from last year. You can look at a 5-year chart, and I would argue that IWM's continuing to be in an uptrend. It just isn't uptrending right now. And it's seriously underperforming the major indices. But I don't know if you've noticed, look down here at growth stocks versus value at the small cap level. The Dow Jones US small cap growth versus the Dow Jones US small cap value. We just set a new 52-week high, money rotating into growth. You might not realize that because small caps overall have been so weak. Even the small cap growth has not been that strong, but under the surface, money is rotating into small cap growth. Why? All you recession lovers, why is growth stock? Why are the small cap growth stocks crushing value right now? 52-week high. And it's not just here. How about we go to the mid cap MDY and let's pull up the mid cap growth versus mid cap value. Want to see this one? Same thing. Mid cap's going down. Look at the mid cap growth versus value. It has been soaring in 2023. So, I mean, it got off to a great start on an absolute basis and on a relative basis. But as prices have been coming down, don't lose sight of what's going on underneath the surface. We've got growth leading, crushing value. It's not just at the large cap value or large cap growth level. It's across the board. What do you think the stock market's forecasting by moving into growth? I can tell you what it's forecasting: lower interest rates. Because there is weakness in the economy. The Fed's done whatever it needed to do or it thought it needed to do for inflation. It's done. Inflation's rolling over. Bond market is saying inflation is dead from this point forward. So the Fed can turn its attention. and it can turn its attention to the economy, which means we're going to have lower rates ahead. All right. Anyway, I just wanted to point that out. I thought, we know large cap growth. Large cap growth's been on fire. I think that's been in the news. Everyone's seen that. People are talking about the FANG. This is a narrow advance. No, it's really not as narrow as you might think. Money is rotating into growth at all levels. I find that to be very bullish. So let's move on to earnings. What I wanted to do is just go over, and I'll tell you what, we're going to do the earnings and the 3 you must see combined. Let's look at 3 earnings reports. So I'm going to pull up first Home Depot. Home Depot reported this morning, and we're going to do it on the symbol summary. You can still see this chart down here. Home Depot has not been a good stock. It's been going down. It's in a little bit of a bear flag. And guess what? It's down another $7 today with earnings, $2.81. Does it hold on to that March low? That's what I'll be watching. But Home Depot not looking great. How about Baidu? Baidu reported. Baidu had been very strong, a little bit different than what we were seeing on HD. Baidu had been going up, but just recently heading into earnings, it had weakened. Now, I think this area of support down here around 117, 123, right in this area, that's the level I would continue to watch. Which way do we go? Right now, we're flat after earnings. And then the last one I have for you, here was a pretty big beat, smaller company, Stratasys, SSYS. Stock's up over 5% today. Quick little gap up over 15. It's in an uptrend. I wouldn't be surprised to see this one head up to challenge that 16.5 level. All right, that is it for me. I appreciate everyone tuning in. Come join me tonight for the Max Payne. Love to have you again. Go over to Earnings Beats. Start your no-cost trial. If you're new to Earnings Beats, you just want to kind of get to know us a little bit, go down and sign up for our free newsletter. Love to have you. Have a great day, everybody. Happy trading.